Hello and welcome to mahindraguru.com, the Brahmastra for Success, and we welcome you to our new show that is Facts and Myths. In this show, we will discuss on the facts and burst all the myths that you have regarding the subject general awareness. With further ado, let's see what is the topic that we have at hand in this particular discussion. The topic is that is Basel norms. Now, Basel norms has always been an Achilles heel for every aspirant who wants to crack the bank examination. So let's see, and we would try to help you out in deciphering all the confusion regarding this particular subject. First and foremost, the most important component of this particular topic is capital adequacy ratio. Every aspirant has a doubt that what is a capital adequacy ratio. Let's discuss first the formulae and then I'll tell you what could be the definition. Now the formula is total capital upon risk weighted assets into 100, that is capital adequacy ratio. Now that is the formula, but what is the essence or meaning of this particular ratio? It's very simple. The amount of risk that can be incurred in form of loss from the total capital, that particular measure is described by this particular ratio, that is capital adequacy ratio. So let's see how the definition would suffice in this particular formula. Now the first one, that is total capital. That is the amount that the bank has it with itself, that it can use for the loss recovery. The denominator part has risk weighted assets, that is the amount of risk attached to an asset. So the loss incurred, that would be from the RWA, that is risk weighted assets, and the amount resolved or provided for would be from the total capital. So it is a ratio that tells us the amount of loss recovery a bank can possibly do in the near future. That particular ratio is capital adequacy ratio, in which the numerator part, that is the total capital, has two components, tier 1 and tier 2. These two components tell the bank how much of amount of capital is with the bank for loss recovery, and the denominator part, that is the risk weighted assets, tells the bank how much of a risk a bank has with its own assets. Now assets could be multiple. It could be a loan, that could be a secured loan or an unsecured loan. It could be a deposit, it could be the cash credit. So anything that is of the bank, that is owned or partly owned by the bank, that would form as the asset. Now a loan with a collateral would be a low risk asset, but a loan without a collateral would be a high risk asset. So we have to keep in mind the risk, and we have to also manage the capital that would be in the tier 1 or the tier 2 capital. Now what is a tier 1 capital and what is a tier 2 capital? First and foremost, the tier 1 capital is called as you can see on the board on the screen, it is core capital. The amount of capital that the bank would use for the first time to recover the loss. And after the usage of this particular capital, the bank would continue to do business. So this particular capital would have chunks of equity part and least or negligible amount of the debt part. So it would only contain the equity side. For example, the paid up capital, the preferential shares, the profit carry forward, the reserve from sale of assets. So anything that is from the equity side would be the tier 1 capital that would be used for the very first time by the bank in case of a loss. Now, after the usage of tier 1 capital, if still the bank has a huge number of loss or has amounts to offer to the customers or amounts to resolve for the loss, then it would use the tier 2 capital that would be used as a supplement to the tier 1 capital. So the tier 1 being the core capital, tier 2 would be the supplementary capital that would have several examples. For example, a subordinate term debt, general loss reserve, undisclosed reserves. These would be the part of the tier 2 capital. Now the first thing that you have to keep in mind is in the examination is what could be the question from this particular topic. The question from this particular section would be that which of the following is an example of tier 1 or tier 2 capital. So you have to note down this particular example because questions have come in the previous examinations regarding this particular section, that is which is a tier 1 capital and which is a tier 2 capital. Let's move forward and let's see the history of Basel norms. Now, if we talk about the history of Basel norms, it's earlier the Basel norms were provided by the BCBS, that is the Basel Committee on Banking Supervision. Now, this committee has a sub-body or has a sister concern, that is BIS, which also is the headquarters of this particular body. Now, BIS stands for Bank for International Settlements. The difference between these two are the BCBS is concerned primarily with the banking supervision, but BIS is concerned with international banking and international banking messages. Recently, our Honorable RBI Governor was appointed as the Vice Chairman of BIS. So keep in mind what is a BCBS, that is Basel Committee on Banking Supervision, and then we have the headquarters or the sister concern, that is BIS, that is Bank for International Settlements. Also keep in mind that Stephen Ingves is the chairman of BCBS, but we have a different chairman or president for BIS. So let's move forward and discuss about the Basel norms. Why was there a need, and what were the features of Basel 1, 2 and 3? Now, Basel norms had a single agenda to guide the banks to save money, to accumulate capital, so that in future they could recover the loss. So they coined a term, that term was minimum capital requirements. Now a bank has to maintain a minimum capital so that in future when there is a loss, that capital could be used for loss recovery. So that was the concern in the Basel norms, and that led to the first part in 1988 that was called as Basel I, which was implemented in 1992. It had a single point agenda that a bank has to maintain a minimum capital. Now, after the humongous success of this particular norm, we had the second part that was called as Basel Accord 2 or Basel Norms 2. You can see on the screen that it was established in 1999, but the final draft was in 2003. And the implementation in 2006, but in India it was implemented on 1st April 2009. Now let's discuss what's the difference or what are the intricacies or features of Basel II. Now Basel I had the first pillar, that was minimum capital requirements, which had the ratio, that was capital adequacy ratio, and it was at 8%. Now what was the 8% or 9%? Now any bank has to maintain an amount of RWA at all times, so that if that RWA, that is the risk-weighted assets, gives a loss or incurs a loss, that particular percentage could recover the loss. So the CAR percentage was in the minimum capital. Then we had two other pillars in Basel II, a supervisory review process that had three risks. Number one, credit risk. Number two, market risk. And number three, that is the operation risk. Now in the credit risk, a bank used to provide loans, advances. The risk on these particular sort of activities was encompassed in the credit risk. Then we had the second, that was the operation risk. Now in this particular part, the bank employees salary, the capital invested in the land acquired for the bank operations. Now that was in the operation risk. And the third was the market risk. Now recently, as in around 5-6 years back, there was a recession in the US. Various banks fled or various banks were bankrupt because of that particular event, but some banks managed to recover or were undeterred from that particular calamity. Now the risk for banks like Lehman Brothers was humongous, the market risk, but for banks like Merrill Lynch, that was not that big. So we have to keep in mind that the market situation could also lead to a loss or also lead to the doom for a particular bank. So that was the third part, and that was in the pillar 2. And in the pillar 3, we had the market discipline, in which in the later lectures we will discuss Camel's rating, and then the subsequent that is the inroads rating in the next lecture. So that was in pillar 3. So we had three pillars: pillar 1, pillar 2 and pillar 3. Now the CAR percentage that was assigned here was 9%. Now in the Basel II norms, there was a formula for maintaining the tier 1 and also tier 2. I have a simple question: which capital of the two, that is tier 1 or tier 2, should be maintained most? The answer is tier 1, because tier 1 contains the equity capital that is owned by the bank itself. So that should be increased and tier 2 should be decreased. So they had a formula that was, you can write that down, tier 1 is equal to twice of tier 2. That meant that tier 1 had to be twice of tier 2 so that the bank has loads of capital for loss recovery. Now, in the Basel III norms that was introduced on 1st January 2013 and shall be fully implemented by March 31, 2019, had other ideas. Now, it had additional ideas and also a certain amount of different set of norms. Now, they also focused on tier 1, but the tier 1 amount had to be increased big time and the tier 2 was decreased to a considerable amount. Now, in this particular norms, the tier 1 was divided into 2 or 3 parts. Number 1, the core capital, that was the tier 1 originally, that had to be kept at 5.5% at least of the RWA. So, if for example, if the RWA assets are 100 crores, 5.5 crore had to be kept in the core capital. Second was that the tier 1 that contained the core capital should be at least 7%. So 5.5% was the minimum, but it should have at least 7% including the core capital. So gradually the CAR had to be at 9% initially for the implementation of Basel III, but for the achievement it has to be at 11.5% of RWA, which has to include this particular feature, that is capital conservation buffer. Apart from the tier 1 or apart from the core capital part, we had an additional contingency buffer that was called as a capital conservation buffer that had to have 2.5% of RWA additionally to the 9% RWA. So by adding these two particular parts, by 31st March 2018, the bank has to maintain a minimum CAR of 11.5%. So this was the Basel III norms and its features. Now this particular feature had an addition. This addition was done by BCBS and also implemented by RBI, and that is DSIB or GSIB. Now DSIB stands for Domestic Systemically Important Banks and GSIB stands for Global Systemically Important Banks. Now what are DSIB and GSIB? Now every year from 2015 in month of August, RBI would tell the government and the citizens that there would be certain banks which have to maintain certain percentage amount above the minimum capital, that is 11.5% or 9%. Those banks would be termed as they are too big to fail, as in if they fail, huge chunks of capital would be drained and that could lead to an economic slowdown. So these banks would be anointed. These banks would be provided a separate target so that they are at a far better stability than the other ordinary or the normal banks. So this very year, as in the previous year, RBI announced two particular banks, SBI and the ICICI Bank, for the particular status, that is DSIB. Similarly, the BCBS would appoint a GSIB that would be too big to fail for the entire world. All these banks have to maintain a certain capital that would be provided in types of buckets: bucket 1, bucket 2, 3, 4 and 5. Now the ICICI Bank, apart from the common equity or the minimum CAR, has to maintain 0.20%, and so it has been kept at bucket 1. SBI being the largest public sector bank lender, that particular bank has to maintain 0.6%, that would be in bucket 3. So in the coming years, we would have different sort of banks in different buckets so that those banks are far more stable than the other banks. Now, in the end, we hope that we have made it pretty clear about what to study and what are the facts and what were the myths regarding this particular topic, that was Basel norms. We hope you enjoyed the entire discussion, and in the coming weeks we would discuss on different confusing and taxing topics that you have while preparing for the bank examinations. Best of luck for the SBI clerk that has to happen in the coming months, and thank you so much. And keep on watching mahindraguru.com. Your success is our success. Thank you so much.